Hey, can you see me now? I think maybe you should be able to see me now. I have no idea what was happening. Boom. All right, finally, confirmation. Sorry about that, guys. Now I'm going to try and share my screen. All right. Thanks for bearing with me. Cool. All right. Today we're talking about a very exciting topic, and that is inventory. So let me just get this going. Oh, and I'm going to pull up the questions real quick that a few people left in the Facebook group. All right. Ready to go. Back it up. All right, inventory. And hey, good morning, everybody. Welcome. And here we go. So we're going to talk about how to deduct inventory, how to track inventory, how to deal with personal items, how to deal with donated inventory, and how you deduct that. So first, let's just dive into deducting inventory. And feel free to leave your questions in the comments. And throughout, I'll answer the questions that are on the Facebook post. So okay, so this used to be a tax generally not acceptable to deduct your inventory immediately when you purchase it. So prior to 2018, this typically was not allowed for most businesses. And with the Tax Cuts and Jobs Act of 2018, this actually loosened up quite a bit. So now you can actually, if you meet certain guidelines, you can deduct your inventory when you purchase it rather than having to wait until you sell it. And that made things a little bit confusing. And so I really like this slide. So there are two main accounting methods when you're talking about accounting, your bookkeeping. So you can either use the accrual method or the cash method. And I'm not even talking about inventory right now. I'm just talking about overall. So the accrual method is when you recognize sales, when you recognize income, even when you haven't actually received the cash. So it's like me, I do somebody's taxes. If I were using the accrual method, when I do somebody's taxes and I send them an invoice, even though they haven't paid me yet, I record income right when I send that invoice. But if I'm using the cash method, I don't record income until they actually pay me, regardless of whether or not I've sent the invoice. And it's the same thing with expenses. If I pay somebody cash, well, let's see, if somebody sends me a bill, when I record that bill in my books, even though I haven't paid the cash yet, I'm going to record an expense if I'm using the accrual method. But if I'm using the cash method, I don't record an expense until I actually give them the cash. Most small businesses use the overall cash method. And for inventory, typically the accrual method has been assumed. So most small businesses use the cash method, but everybody just knew, I mean, in theory, that inventory was treated a little bit differently. So with inventory, historically, you couldn't deduct your inventory until you sold it. So this right here, this was just what everybody did historically. And I want to show you something. So here's a tax form. Here's a Schedule C. And on here, you can see there's a box where you have to mark, are you cash or are you accrual? And remember, this is the overall method. This isn't referring to your inventory. This is the overall method. And historically, everybody would just check cash, even though with inventory, they weren't using the cash method technically. It was just built in. So if you scroll down, you can see the way that inventory is, the way the IRS lays it out is the cash method. It's your beginning inventory. So let's say that's 0 plus your purchases. Let's say that's 10,000 minus your ending inventory. Let's say your ending inventory is 4,000. So if you purchase 10 and you're left with 4, what does that imply? That implies that you sold 6,000. So they're using a formula. Your beginning inventory plus your purchases minus your ending inventory equals your cost of goods sold. So this is what you can actually deduct using the accrual method for inventory, which has always been a part of the cash method, the overall cash method. I don't know if that makes sense, but that's how it's always been. Because sometimes people ask me, well, how can I check cash here if I'm using the accrual method for inventory? And I say, well, that's just how it is. But now, since 2018, so technically it's a hybrid method because it's cash for everything except for inventory. So using this method of accounting for your inventory, it's a better indicator of your income. And I'll show you an example of what I mean by that. But it matches up the expense, the inventory expense, with the revenue that it belongs to. And with this method, it does require a little bit of extra tracking because you have to know the cost of everything that's sold. So you have to track that accordingly. So now let's talk about what has recently become available in the past couple of years, which is treating your inventory on the cash method. And all that means is you can deduct it right when you purchase it. So let me show you that Schedule C again. This is set up for the accrual method, but if you are using the cash method, then the IRS doesn't even consider you to have a beginning or an ending inventory. So all you would do is just list your total purchases on this purchases line, and that would flow through down to the total, because really you're doing 0 plus 10,000 minus 0. I don't even bother putting the zeros. And then your cost of goods sold ends up being 10,000. Even though it's not technically the cost of the goods that were sold, this is just the form that's always been, and this is the only way that you can account for the cash method of inventory. So you'll just list the purchases, and that's it. So the cash method, the one requirement that the IRS, well, not the one, but the main requirement, the way that they say that you can use this method is if this is also how you do your bookkeeping, whatever that means. So you can't do your books on the accrual method and then use the cash method on your taxes. You have to use the cash method on your books, and then you can use it on your taxes. So this method is definitely simpler. It requires less tracking. So which method should you use? It really just depends. You know, do you want more technically correct financial statements, or maybe you don't even do bookkeeping and you don't care, so you just want simplicity, and this is probably the way that I would go. Hope that makes sense. So here's a question. What if you have inventory and you don't buy much this year? Yeah, if you're using the accrual method for inventory and you have a lot of ending inventory, wait. I gotta think about that. Depends which method you're using. If you have a huge inventory but don't buy much this year, I mean, it's definitely a timing issue. If you're using the accrual method and you end the year with $10,000 of inventory, that's inventory that you didn't get to deduct this year. But in theory, you'll be able to deduct it all the next year, which is when you'll realize that deduction. On the other hand, if you're using the cash method, you get to deduct all of your inventory that you purchased this year, but next year, when you're actually selling that stuff, you're not going to have a deduction to offset the sales that you're generating. So you're going to have higher taxes. So it's really just a timing issue. Jeff is asking, are any wholesale businesses using cash method for inventory? Yeah, probably now. I think a lot of people are, especially bigger small businesses, were hesitant or are hesitant because it was really kind of a gray area. The IRS has given more guidance around it, but it's still, I don't know, the IRS language is confusing, but yeah, there are definitely a lot of businesses using it now. So Lori, if I buy it, record the cost of goods. If you sell 75% of it, donate, get rid of 25% of it. Is that okay? Yeah, that's okay. I think so. If you have, if you sell, let's say 7,500 out of 10,000, and you donate the remaining 2,500. Yeah, the stuff you donate and get rid of, it's as if you sold it just for $0. So you still can deduct that as cost of goods sold, and we'll talk about that. Okay, one more question, then we'll move on. What happens if you bought inventory last year thinking you were going to start your business last year, but that didn't happen, and you're planning to start your business sometime this year? If you're using the accrual method for inventory, it wouldn't make a difference because you won't deduct that inventory until you sell it. If you're using the cash method, depending on how much inventory it was, you may or may not be able to deduct it all in that year. That has to do with startup expense rules. So expenses that you incur when you haven't officially started the business yet sometimes aren't deductible in that year, and that just depends on how much. Okay, so let's do this this example. You spent $10,000 on inventory. Oh, I think this is populating incorrectly. Oh yeah, so these two columns. So this first column, just try and look at this by itself. So you had sales of 6,000. Sorry. You spent 10,000 on inventory. So using the cash method, you would deduct all of that 10,000 as cost of goods sold. And that would give you a gross profit of 4,000. Let's just say you had other expenses of 500, so your net income is 4,500. The fact that you sold $1,500 of inventory doesn't affect anything because you don't deduct it when it sells. You deduct it when you purchase it. So then let's move to January. Let's say you had sales of 6,000. You didn't purchase any inventory, so your cost of goods sold is 0. You had the same other expenses. Your net income is a lot higher because you didn't have any cost of goods sold to offset your January sales. So you can see how with the cash method, your inventory purchases can really affect how your profitability looks. So there can be these wide swings. And that's the only downside, especially if your buying patterns aren't consistent. It can sort of make your profitability a little bit, it can sort of muddy the waters. So now let's look at how this would look with the accrual method. Same example. You have have same sales of 6,000. You have the same, well, income of 6,000. You sold the same amount of 1,500. So now you're actually deducting only what you sold. So 6,000 is the selling price. This is what the original cost of that inventory. So that means you have a gross profit of 4,500, same expenses of 500, net income of 4,000. And these sales numbers are remaining the same. So in January, you have sales of 6,000, which was $1,500 worth of inventory, just like last month, but this month you're not deducting what your purchases were. But anyway, you can see how the net income is even from month to month, because this is actually matching the expenses, the cost of goods sold, with the sales that they belong to. Whereas in the example before, you're just deducting everything. The 1,500 is cost of goods sold. That is correct. Yes. So here's a good question. Are there IRS guidelines, and we'll talk about this a little later, about transitioning from accrual to cash? And there are. So there's this, the IRS doesn't want you to switch back and forth. You can change, but they don't want you switching back and forth every year. And technically, to do that, you're supposed to fill out this 3115 form, which is an insane form because it tries to, it's called application for change in accounting method. And there are like dozens, if not hundreds, of different accounting method changes you can make. And the inventory cash to accrual is just one of them. So trying to figure out where that fits on this form is just crazy. I mean, most of it's not going to apply. And honestly, if you just do I'll just say, if you just make the adjustment and make sure you're not double counting anything or missing anything, and maybe forget to fill out this form, it's not likely anybody would ever know. All right, so let's move on. Oh yeah, so here's the comparison of both of those together. Okay, so which method should you use? We talked a little bit about this. So if you're selling as kind of a hobby, kind of a side hustle, bringing some extra cash, you're not super enthusiastic about the bookkeeping, even though I'm a big proponent of keeping perfect books. If you value simplicity, if your activity is just kind of steady, you're not like actively trying to grow, this might be a good method for you. If you might consider the accrual method if you're more serious about the growth, if you're more serious about your numbers, about the visibility into your profitability, if you're looking for financial insights. So the accrual method, again, and I'm just going to keep emphasizing this, it's deducting your inventory through cost of goods sold only when you sell it. That's why it's called cost of goods sold. Here's what the typical profit and loss looks like. So you have your sales minus your cost of goods sold, which equals your gross profit, minus your expenses, which will equal your net profit. If you're using my cost of goods sold spreadsheet, you don't, if you're using, depending on which one you're using, the most recent version I have allows you to update the year, and you don't necessarily have to get a new sheet. But if you'd prefer to not have all the sold inventory on there, you can start a new sheet. So, okay, don't turn off your computers. This is just a little bit of how the accounting works. You don't necessarily have to know this. This is just your profit and loss versus your balance sheet. So this is your income and expenses. This is your assets and liabilities. This becomes more important when you have a partnership or a multi-member LLC or an S Corp. But yeah, here's that P&L again, profit and loss. Your balance sheet is your assets like cash, inventory, equipment, loans, credit cards, and your contributions and your distributions, your earnings. So this is just something to be aware of, nothing you need to know. You can leave that to an accountant. So let's just do a quick example. Let's say you purchase a $30 item of clothing. You sell it for $50. Okay, so your profit's going to be $20. And I just want to show you how that affects these two different financial statements. So when you purchase it for $30, you're subtracting cash from your balance sheet, from your business, and you're increasing your inventory. This is if you use the accrual method for inventory. That item becomes inventory. It's not an expense. You're not deducting it. So it becomes an asset for you. So now you have $30 of asset of inventory. And then when you sell it, you're collecting $50 of cash. So your cash is increasing for $50, and your inventory, which cost you $30, is you're getting rid of it now because you sold it. So you subtract out that same original cost of inventory. So where does the extra 20 go? Right there. Because simultaneously you recorded 50 of sales, 30 of cost of goods sold. So that is the missing 20 over here, the net profit. And that goes right here. And that, I'm realizing this might be confusing, but this is just kind of to help you see how it all fits together. There's two sides to every transaction. And if you use QuickBooks or you use some type of full service accounting software, you might run into having to do a journal entry. So there's two sides to every transaction. There's a debit and a credit. The inventory is debited for 30 and the cash is decreased or credited for 30 when you made that original purchase. And you can go back and reference this if you want to learn more about these journal entries, but this is kind of accounting 101. When you sell it for 50, you debit cash, which means your cash is increasing. You credit sales, so your sales increase on the right, so those are increasing for 50. Yeah, I'll let you go back and look at that. But so let's talk about how to track inventory. And this will depend on the type of selling that you do. I mean, I'm really thinking about enhancing my bookkeeping course. And this is a challenge that I'm having to think through because not everybody should do their bookkeeping the same way, because it depends on, are you doing retail arbitrage? Are you doing online arbitrage, Amazon FBA? Are you selling on eBay? It just depends. So you could get some type of inventory management software. Typically, this is going to be overkill, I think, especially, if you're a company that sells a few specific products, this might come in handy, but if you're selling all different stuff that you're sourcing, this could be just overkill. QuickBooks has an inventory module, I think, but even with that, I think it's just easier to track it offline. And when I talk about tracking inventory, we're talking about the accrual method for inventory, because if you use the cash method, you don't have to worry about that. So this all relates to the accrual method for inventory. Yeah, you could use a spreadsheet. You could use a copy of a combination of both. So within the accrual method of inventory, there's different ways of tracking your inventory. You can use the cost method, which is basically tracking everything individually. And I have a spreadsheet that helps you do this. But at some point, that's going to become, if you continue to grow, that's going to become tedious, unsustainable. And then you can use something like first in, first out. This is actually what I use for my business. Or you can use average costing, which I'm actually thinking about switching to personally for me. So here's that chart again. Within the accrual, within this situation, you can use, so that's how those fit in. You can use the cost, something like first in, first out, something like average costing. And I'm not going to go through examples of all of those on this live, but I do go through those in the module in the course. So I'd suggest checking those out. And I do have a spreadsheet for this one and this one. So yeah, this one I have a spreadsheet for. Typically, I mean, all you need is the item description, the purchase price, purchase date, sales price, and the sale date. So those 5 basic pieces of information to track your cost of goods sold. And that's really the main purpose of my spreadsheet. A lot of people, well, some people get confused because they think it's to do all their bookkeeping, but really it's the main purpose was to help you track your inventory. Although I do want to enhance those a little bit eventually. So let me just say a word about FIFO. This typically is designed for companies that sell a lot of the same thing. So I don't have any of my products right here, but let's say I sell these markers and I buy them, 1,000 at a time from my supplier, and they charged me, let's just say, I don't know, 10 cents per marker. But then next month, when I buy 1,000 more, they charge me 15 cents per marker. So in my inventory warehouse, I've got 1,000 markers at 10 cents and 1,000 markers at 15 cents, and they all get mixed together. So when I sell a marker, what's my cost of goods sold? Is it 10 or is it 15? So with FIFO, first in, first out, first I have to use up 1,000 of the first cost I incurred until I can get to the second cost. So my first 1,000 markers that I sell will come out at the 10 cents. The next 1,000 I sell will come out at the 15 cents, regardless of which actual marker I'm selling. And I do a better example of that in the module, so you can check that out. So average costing is a good alternative if you're getting sick of tracking individually, because instead of tracking everything individually, you're just tracking totals. What's the total number? What's the total quantity of items I purchased? And what was the total price? With those, you can divide the quantity into the total price to get an average cost, and then you multiply that by the total items sold. So it's a rolling average, and I have a spreadsheet that helps you do that as well. So I don't think this slide applies to any of you, so we'll just skip it. Just kidding. So what if I've been doing it incorrectly? This means what if I've been doing the accrual method incorrectly? And the answer to this could change depending on how you've been doing it. So yeah, we'll go through an example. So yeah, let's say you've been using the cash method up until now, but you feel like you should have been doing, or you want to do the accrual method. So you'll have to come up with some type of system, whether it's separating those items in a spreadsheet or physically separating those items that you already purchased and already deducted on a prior tax return. And then in the future, then as you purchase new inventory, you'll have to keep it separate from the old stuff, which was already deducted. And then as you sell the new stuff, you'll deduct it. But as you sell through the old stuff, you won't deduct that. And eventually all that old stuff will be gone, and then you'll only have that new pile that's 100% accrual method. So here's an example of that. Let's say it's June. You have an inventory balance of 5,000. 3,000 of it was both purchased and deducted last year. So you were doing the cash method last year, but now you want to do the accrual method. So 2,000 of it was purchased this year. So make sure you separate that 3,000 so it doesn't get mixed in with any of the new stuff because you already deducted that. And again, we're talking about switching from cash to accrual. This might not apply to a lot of you. So if like doing all that separation and tracking isn't feasible, just exclude the 3,000 from your beginning inventory and use beginning inventory plus purchases minus ending inventory equals your cost of goods sold. So you would actually just show a beginning inventory of 0. Okay, so this is a question I get asked a lot. Before I do this one, I just want to answer a couple of the questions. I think I can just show this on the screen. I don't know if you can see that, but Helen asked, oh yeah, I'm doing a lot of taxes right now. My capacity is getting to its limit, but I could still potentially help. So what Matt asked, what are advantages and disadvantages of zeroing out inventory at the end of every year? So that is basically saying to me, what are the advantages of the cash method, which I think we covered, mainly the simplicity. Okay, Lori says she's okay on this one. Tammy says, should I add taxes paid on a product at the time I'm listing it, or should I write it off at the end of the year? If you're incurring sales tax on your purchases of inventory, or if you are paying for shipping as part of the purchase of that inventory, those additional costs become part of the overall cost of the item. So those are all deducted as cost of goods sold. So if I buy an item for $10 that had $1 of shipping and $1 of sales tax, that entire $12 is going to be my cost of goods, is going to be the cost of that inventory. Is there any special documentation I need for destroyed, removed inventory other than books? We'll talk about that. Well, yeah. So if you get rid of inventory because it's obsolete or damaged, then it is as if you sold it for $0. As far as documentation, I mean, if you're throwing it away, you're not going to get any special documentation. So I don't think so. I just wouldn't worry about it. Tammy said, does it matter if we use 2 different methods for managing our inventory and cost of goods sold? For example, can we use the average inventory method for the vintage and then another method for the new items we sell? So yes, only if the method you are talking about is one of these on the bottom. It can't be accrual and cash. It has to be either or here, but you could do a combination of these below. You just want to make sure that you're not double counting anything. Like for me, I use FIFO for everything, but then like hiking and camping utensils is what I sell, and I use FIFO. But let's say that, you know, something abnormal happens in my business and I sell a car as part of my business. I'm not going to throw it in here because that's going to sort of, or if I were using this, that would really throw off my averages. So in that case, I would just use a one-time cost method for that. Okay, and let's do this last one from Don. Small eBay seller starting to track inventory for the first time. I'm doing modified cash basis. Awesome. Using the spreadsheet. So the question is about the death pile. Should I add it to my cost of goods sold when I sell it? It would be impossible to inventory everything. Yeah, you want to make sure you're accounting for it and deducting it somehow. So what I would do is so if that inventory is not already accounted for, I would add it, the year you list it or the year you finally account for it, that would be part of your purchases. So your purchases would increase, and then, yeah, there are different ways to do it, but ultimately, yeah, that would end up being part of your cost of goods sold. Just seeing if I missed a few questions in the chat. 6 years in business, never tracked inventory until now. Recently entered all my inventory into the database, but made up dates of when I purchased it. Should I go back and correct the dates? No, the dates don't matter. Like the only thing that matters is whether or not you've already deducted that inventory. If you haven't already deducted it on prior tax returns, then you could just put a January 1st date. Doesn't really matter. Should we? Oh, I answered that one a little while back. You could use the same file. Okay, Stefana says, is there a good program that'll read PDF receipt and convert it into the spreadsheet where you're keeping track of inventory? Oh, not that integrates with my spreadsheet specifically, no. When you buy an item for Goodwill, sometimes they ask if you want to round up to help support their programs. How do I account for that amount? Oh, that's a good question. Yeah, so that part would not become part of your inventory. That would be like a separate charge that you would have to itemize out. So if you spend $9 and you round up to 10, that's $9 for inventory and $1 for a donation. And that donation for most sole proprietors or single member LLCs, it doesn't count for the business. It's not a deduction for the business. It would have to be taken on your personal income tax return. Can you just use average cost method for determining cost of items purchased in large lots? Yes, totally. But then record each sales price individually. Also, yes. Yeah, I don't think you would do. Yeah. I think the answer for that one is just yes. Can you, and I just got 2 more questions, then we're moving on to personal items. Can you instead say the shipping is an expense and just consider the item cost along with any selling fees as cost of goods? Yeah. So that's a good question. I don't know how strict they are around that. Like I've seen people do both. I think either is fine. If the credit card is all being used for business, then I think, yes, that the interest would be a deductible interest business expense. All right. Personal items. Example, diving into an example. Let's say you have a, I used the wrong picture. I don't even know what to call this. Jacket for $400 3 years ago, and then you just sold it for $300. Those are the facts. What's your deduction? So it's a personal item. We're trying to figure out how to deduct it. So the typical, like the standard accounting rule is called the lower of cost or market. So if the original cost is lower than the market value, you'll use that. If the market value is lower than the original cost, technically you should use that. Trouble is, we know the original cost, but what's the market value? So there's probably a lot of wiggle room there. It's kind of hard to come up with a really solid, definitive estimate on that. Because maybe you see the same jacket selling at Goodwill for, I don't know, maybe somebody mispriced it for $100. And then maybe you see it new in a catalog for $1,000. So that's a big range. So then how do you determine the market value? Some people are like, well, so in this example, some people say, oh, I sold it for $300. That means that's the market price. So I sold it for $300. My cost of goods sold is $300 and my profit is $0. Awesome. No tax, right? Yeah, you could do that. I think that's an aggressive approach because that's only one data point. Is that really the true market value, or is that just what you happen to sell it for? So let's say the market value is $200. Let's say that you come up with that. Well, I don't know what I'm trying to say with that $200. I'd have to go back and watch the module. But what you can do to determine a market price, just something that you can do is say, well, if I bought it for $200 and I sell it for $300, then let's just say, take the midpoint as a conservative rule of thumb to determine the market value, which would be $250. So then I guess I'm using this 200 in my example. So you bought it for you sold it for 300. Your cost of goods sold is 200. Your profit is 100. You know what? Just disregard that last slide. I think I'm telling this wrong from how I told it in the module. Go watch this in the module, and I'm not just going to try and use this example. I'll use my own example. Let's see if I don't mess it up on this truck. So the original purchase price was $10,000. You sell it for $2,000. So you sell it for $2,000. Your cost of goods sold is $10,000. Profit is negative $8,000. Is incorrect, because is that truck really still worth $10,000? Is that your lower or cost of market value? So it costs you $10,000. The market value with cars, it is easier to find the market value. You can look that up on Kelley Blue Book or something. So say the market value is $1,000. You sell it for $2,000. Your cost of goods sold at that point is going to be $1,000. So yeah, I'm sorry about that. Typically, personal items, as a general rule of thumb, since the market value is such a moving target, unless it's something that's, you can tell, has really like depreciated and it's just like junk, which, you're probably not selling junk, I would just use your best estimate of the original cost. And that's another problem. A lot of times you're not going to remember what the original cost is. So I would say use your best estimate of the original cost. Unless you know that it's just lost tons of value. In that case, estimate a market value. So for donations, it's pretty simple. So businesses can't deduct donations typically, most of us. Most of us aren't C corporations. But your business can make donations, and it'll flow through to your personal income tax return to be deducted there. But only if you itemize deductions. So the itemized deductions are only certain things like medical expenses, state taxes, mortgage interest, property taxes, contributions. If the sum of all these exceeds the standard deduction, of about 24,000, it's a little more than that, 12,000 or 24,000, then you'll take this. But for most of us, these do not exceed this, so the deductions really don't help us. If you're donating your inventory, you don't get an additional deduction for donating it, but you can deduct the original cost. So regardless of whether you donate it, dispose it, or destroy it, it's going to be deducted as cost of goods sold. So it's as if you sold it for $0. So if you buy an item, inventory for $100, and it turns out it's broken and you get rid of it, it's like you're selling it for $0. Sales of 0, cost of goods sold of 100. So, and here's how the formula works. So let's say you have a beginning inventory of 100, purchases of 150. So now you have 150 of inventory, and then your ending inventory is 25. So the difference between the 150 and the 25 is going to be your cost of goods sold. And so the lower that your ending inventory goes, the higher your cost of goods sold will be, just based on the formula. So when you donate inventory, let's say you had 25, you donate inventory of 20, that's going to bring this down to 5. So then you have 100 plus 50, 150 minus 5, and that's going to increase your cost of goods sold. So it's just a function of this formula, how it works. So some people ask, well, is donating it going to benefit me? I've got this death pile. Is it better if I just donate it? Will I get a higher deduction? And the answer is no. I mean, you'll be able to deduct the original cost. So you'll have sales of 0 minus the cost to give you a loss, or you can try and sell all that stuff for pennies on the dollar for a few bucks, and then you'll have sales of a few bucks minus the original cost. So then your profit will be a little higher, or your loss won't be as low. So that is the inventory piece. I'm going to check YouTube. See if I can check YouTube to see if I think the comments are coming through too. Yeah, so I'm getting your comments. Okay, so we went 50 minutes already. I got a few minutes for a few more questions. Let me see if I missed any. Yeah, so this is a good question. So a lot of people say, well, I just sold personal stuff last year, so I'm not going to report on my taxes, which is probably fine, because if you had a loss, you may not owe any taxes and the IRS doesn't care about it. But if you had a loss, then it's only going to benefit you if you report it, because it's going to offset other income you might have, or even offset income from future years. So yeah, it's okay to show a loss. Absolutely. As big as you can get it. Don't hesitate to show legitimate losses. Is it better to try and make up a market price? I recently sold a vintage set of tables, couldn't find any original value on. There's something I had at my home. Yeah. If it's, let's say it's something vintage that, let's say, has increased significantly in value, that's actually not going to have an effect, because remember, you're supposed to take the lower of the market value or cost. So in that case, it's probably more likely that the original cost is lower than the market value. Yeah, I think that's reasonable. There's really, I think, a lot of wiggle room if you're dealing with market values. Yeah, again, I think there's a lot of wiggle room, and I'm not even an expert on this, but I don't know. I think that's a good question. I wouldn't think it's determined by where you sell it or the platform. I think it's just determined by the actual sales price itself. When I buy something that later, let's say I find out is stained and I can't sell it, how do I show that in my inventory records? Yeah, so that's obsolete or damaged inventory that you would just get rid of. So you would just show it as if you sold it for $0. So in the screen I showed below, you would, if you're using the accrual method, you would incorporate that into your ending inventory. So it would reduce your ending inventory value. And when you reduce your ending inventory, when you use the formula, beginning inventory plus your purchases minus your ending inventory, that's automatically going to jack up your cost of goods sold, which is where you're taking that deduction. I'm glad this was helpful. I feel like I've confused a few things, but that's why we have the course, so you can go back and reference it. Now that I'm keeping track, what amount should I deduct this year? So any inventory that you think you already deducted, you won't list in your spreadsheet. Like you won't, well, you'll track it, but only for purposes of excluding it from everything else. You just have to figure out how to separate that. So that might be two separate spreadsheets. So when you see that you have a sale, you'll go back and see what spreadsheet it's on to know whether you just do nothing with it or to know whether you deduct it. If you use market cost because it's lower, do you make a debit in the accounting software to show the difference? Got to think about that. So that would just be the value of, so if I'm thinking about that, so the market value would be the value at which the inventory is recorded on your books. So Peggy says, I have 3 distinct inventory categories: personal items, $100 plus, thrift averages of $5, and retail arbitrage average is 20. Do I average all of them? Yeah, you could. Yeah, I wouldn't worry about like if it's 5 versus 20 versus even 100, I might not worry about it messing up your averages too much. If you're getting up into 500, 1,000, then I might track those individually. So it just depends. Hey, Jennifer. So at year end, you have to have physically count. Okay, so this is another way to do it that we didn't talk about. And actually, this might be the way that some of you want to go. If you have a way of valuing your inventory, here, let me share my screen again. So let's say I have hundreds or thousands of inventory transactions throughout the year, and it's just a pain to do the individual tracking or even the average tracking. I don't want to do that. If I have a way to value my ending inventory, I can avoid having to do all that stuff. Because it's pretty easy. So let's say it's our first year and our beginning inventory is 0. And it's pretty easy to track our purchases. if you're using any simple accounting software, anytime you purchase inventory, you just classify it as inventory, and that's it. You're good to go. I mean, you can get that from your bank statement. And let's say during the year or during a month, our inventory was, let's say, 10,000. So here's the trick, and here's why companies do ending inventory accounts. So our ending inventory, let's say we haven't been tracking anything, but we have a method of valuing our ending inventory, or even just putting a close estimate. Let's say we know it's about 2,000. Well, there you go. So this is the formula. Your beginning inventory plus your purchases, I should have typed purchases, minus your ending inventory is 8,000. If you purchase 10,000 and you only have 2,000 left, that means your cost of goods sold was 8,000. So this is actually what I do with, so I do a little bit of bookkeeping, and one client that I have, I just ask him, I say, hey, what was your ending inventory balance last month? And I don't think he's actually doing a count, but I think he has a pretty good sense of what it is. So he just says, oh, it was, 50,000. So I'll come in here. Let's say he had purchases of 50,000. He's like, oh, it was 30,000. I'll say, great. I'll go in, I'll do a journal entry to reflect the increase in cost of goods sold and the decrease in inventory to get me to that balance. And that's how he does it. So I'm actually, that's when I hope to redo this module after tax season, and I think I'll add this in there. More about startup costs. Yeah, this one, I was actually just reading about this. So yeah, before I get into that, yeah, I actually really like this method because it's simple and you're still using the accrual method. So yeah. So startup costs. So this one is a little bit unrelated to what we've been talking about, and I'm going to wrap this up pretty quick. But so let's say you're not open for business. Let's say you haven't registered anything as a business or anything. So basically the point is you're not open for business yet. You're not organized, but you're out there incurring all these costs. Maybe you're doing research, or you're trying to set up, I don't know, trying to set up your Amazon or Poshmark store or something. So all these costs that you're incurring, unless you're open for business, technically the IRS says those aren't deductible in that year. Well, I think they're deductible up to 5,000, but anything over 5,000 might have to be amortized, like depreciated over the next 15 years. So, yeah, I mean, I'm not going to talk too much about that right now, or you could say, well, even though I haven't had my first sale, I am a business. Like if you're an LLC, you say, maybe I registered my LLC, in the beginning of the year. And even though I didn't have any sales, I was still a business. Anyway, just Google, like, TurboTax has some good articles. Google like TurboTax startup expenses and check out their article on it. But yeah, inventory. I know if you're not using the cash method for inventory, I know it can be kind of daunting to know what the best way to track it is for you. And again, I actually really like this method that we just talked about. I'm going to add a module for that, or a section for that eventually. But yeah, inventory, it's a big piece of our reseller lives. So anyway, I think I'll stop there. Oh, hang on. No, that's a good point. Yeah, if it's an inventory startup expense. But again, if you're using the accrual method, it doesn't matter because you don't deduct until you sell it anyway. If you're using the cash method, that's when it would apply as a startup expense. Okay, Carrie slipped in this question. Consignment shop damaged her items and returned them to her. They paid me, so I consider them sold and deducted as cost of goods sold. Yeah, if you already deducted them and then you sell them again, cost of goods sold would be 0. Exactly. So thanks, everybody. Looks like we had higher attendance for this one than our previous question and answer session. So thanks for coming. And yeah, see you next week when we do deductions and other fun stuff like that. So I'll talk to you later.